Hey guys, it is Julie here with TipRanks. In today's video, we're taking a look at two stocks that are priced under $10 per share and analysts think have growth potential of 100%. So let's get into it. All right, guys, welcome back and thank you so much for being here. Like I said, today we're looking at two cheap stocks that analysts think have the potential to double over this next year. We're going to take a look at what these companies do and exactly what price targets these analysts are predicting. Just before we get into that, this is your friendly reminder that if you enjoyed today's video, make sure you hit that thumbs up button and that you're subscribed to the channel as well. All right, let's get right into these two companies. The first stock we're taking a closer look at today is SQNS Communications. Their stock trades under the ticker SQNS, currently priced at $5.45 per share, down from a 52-week high of $9.57. SQNS is in the chip industry. They are a leader in cellular IoT, providing 4G and 5G chips, modules, and development platforms to IoT device makers worldwide. They have more than 15 years of experience in 4G and 5G semiconductor solutions, with 7 generations of technology developed and commercially deployed. They have a complete range of chips and modules fully optimized for IoT applications. They provide cellular 5G and 4G solutions for the Internet of Things devices in both categories, massive IoT and broadband and critical IoT. The two major technology trends of 5G and IoT represents about an $8 billion opportunity over the next few years. And the company has a global reach. Its products have been approved for use by numerous major wireless operators around the world. This includes AT&T, Sprint, and Verizon here in the US. Now, like I said, their stock is down from highs of over $9.50, which they hit back in February. The company has hit some headwinds that have been facing the chip industry as there have been worldwide shortages. Despite this, they saw plenty of year-over-year gains in their most recent quarterly report. Massive IoT grew by 14% sequentially and over 120% year over year, and their Cat 1 business is exceeding their current plan. They saw 5.1% year-over-year revenue growth, which was impacted by supply chain constraints, but it would be 88% growth by normalizing revenue comparison. At the top line, their revenue came in at $12.9 million, a 5% gain from the year-ago quarter. Their earnings per share at a net loss of 4 cents was better than the 17-cent loss expected, and far better than the 70-cent loss reported in the Q2 of 2020. Hearing from their CEO, Georges Karam, he said that massive IoT was the primary driver of growth in the second quarter, increasing 14% sequentially and 120% year over year. Notably, we achieved this growth despite order fulfillment delays brought on by supply chain challenges that are impacting industries across the globe and that limited our overall growth in the quarter. Our business pipeline is well over $600 million, with the design win portion increasing by 18% to $280 million since last quarter. We're now working on nearly 100 design win projects, with over 40 projects now in the production phase, primarily in massive IoT applications, along with several broadband IoT products. Following their recent quarterly report, we had 5 analysts update their price targets on the SQNS stock. And all 5 of them come in with a buy rating. Their average price target of $11.30 per share would be an upside potential of 107% for this next 12 months. And another great thing to see is that all of these analysts are rated 5 stars themselves. On the low end, we do have a $7 price target from Needham, which would be about a 28% upside. On the high end, we have Scott Surley from Roth Capital coming in with a price target over $16, which would be a 200% growth potential. Hearing more details from Scott, he doesn't dodge the headwinds against SQNS, but he does outline a clear path forward. He says that supply constraints impact both Q2 and the near-term outlook. More importantly, demand remains at record levels, and 2022 supply actions position the company for growth targets of 50% compound annual growth. Their key Q2 2021 notables include IoT sales increasing 120% year over year, record design wins were up 18%, and 2022 unconstrained sales would approach $100 million based on current visibility. We believe that recent company actions have secured sufficient supply beginning in the first half of 2022 to return Sequins to a more normalized growth curve in 2022. So Scott is feeling pretty bullish about the Sequins future here for this next year. Now, the second company we're taking a closer look at is Digital Media Solutions. Their stock trades under the ticker DMS, currently priced at $7.55, down from a 52-week high of over $15 per share. Digital Media Solutions works in ad tech, applying tech solutions to online ads. They are an innovative global solutions provider of digital performance advertising and a connection point between digital advertising clients and their prospective customers. Leveraging proprietary ad tech and robust consumer intelligence, they connect brands with consumers at the moments they're most ready to take action, using messages proven to resonate. They're judged by both quality and volume and deliver results. Their customer acquisition campaigns remain sustainable and predictable even as media spend scales. Digital Media has a consumer intelligence database backing its campaigns, allowing it to fine-tune customer acquisition, advertiser accountability, and project budgets to get clients the best results for their dollars. They have insights and signals that put the right message in front of the right consumer at the right time, and they provide a linear connection between ad spend and results. They help their advertisers launch, edit, and optimize campaigns quickly. They have a significant and growing brand name roster of blue chip clients across diverse verticals. They have 10 of the largest U.S. insurance firms, 2 of the leading home security companies, top 3 mortgage lenders, and numerous personal fitness, health, and wellness brands. While the stock has been volatile, their recent quarterly report does show a steady gain. Their second quarter top-line revenue came in at $105.1 million, a company record, and up 39% year over year. Their net income also grew year over year from $2.1 million to $4.9 million. Earnings per share, which was a negative 1 cent per share in the year-ago quarter, came in at a profit of 7 cents per share. DMS management noted that the brand direct solutions and marketplace solutions brought in the bulk of the gain, increasing $14.5 million and $22.5 million respectively. Hearing from their CEO, Joe Marinucci, he says that our strong second quarter performance is thanks to a confluence of circumstances that we strategically and deliberately constructed for ourselves. We continue to see a competitive advantage as a result of leveraging our first-party data asset, proprietary technology, and expansive media reach. We made strategic investments in terms of acquisitions, technology enhancements, and new hires that boosted every part of our business. The advancements we made during the second quarter should serve us well during the upcoming open enrollment period and holiday shopping seasons. Following their quarterly earnings report, we had 3 analysts reiterate their price targets, bringing us to 4 overall analyst ratings. And once again, they come in with unanimous buy ratings. The average price target of $14.50 would be a 92% upside potential. And once again, these ratings come from analysts that are rated very highly themselves. On the low end, we have a $12 price target from Craig Hallam, which would be a 58% growth potential. And on the high side, Canaccord Genuity's analyst has a $16 price target, which would represent a growth potential of 111%. Hearing from BTIG analyst Marvin Fong. He says that we believe this was a constructive quarter as it showed DMS is beginning to deliver on margins while still delivering healthy double-digit organic growth. We believe investors have been waiting for a quarter where DMS demonstrated strength on both growth and margins, and their Q2 results should go a long way to getting investors comfortable on DMS's ability to manage those 2 KPIs. We believe the increase in CES, while a bit hard to translate to a direct financial impact, was nonetheless a very positive indicator that DMS is delivering strong results for clients while also navigating a turbulent COVID impact ad environment. So there we have 2 stocks, both trading at about half the value of their 52-week highs. But analysts seem pretty confident that they're going to turn the ship around and see some great growth over this next year. Now, I'd love to hear your thoughts on these 2 companies. Were they 2 that were on your radar already, or are these brand new to you? And what do you think about that future growth potential? Make sure to let me know your thoughts in the comments down below. Please keep in mind that these videos are never a suggestion to buy or sell any specific stock and are just meant for information and entertainment purposes. Please make sure you're always doing your own research and due diligence before making any investment decision. If you made it all the way to the end of today's video, make sure you hit that thumbs up button and that you subscribe to the channel as well. Thank you guys so much for watching. Have a fantastic day, and I will see you back here next time.